Hey Guy,
Hey,
how's it going?
good, good. And you?
I just got back from some traveling, so I didn't get a lot of trading or any done this week at all for work traveling. So, um, yeah, then I caught up on family life when I got back. But I've been reading the book about Jim Simons.
Uh-huh.
That I read about half that on the plane, and I wouldn't say it's like changing any of my strategies or anything like that, but it's just it's kind of motivating. I think if anything, yeah.
Well, there's a what I would consider a companion book to that, which is called Lecturing Birds on Flying. And it's written by the son of one of the people who gave Markowitz his PhD. So, Markowitz was the guy who did modern portfolio theory.
Uh,
So it's interesting that people get a lot of math envy. And if you look at a lot of math and those symbols and stuff, I mean, it looks like something out of a Harry Potter book. Um, and the hubris of math is that they believe that they can symbolically capture all of reality or all of a domain within their symbols. And as I read that book, I thought to myself, if they had hired a trader from the beginning, just letting Ron in. If they had hired a trader from the beginning, he probably would have sped them up by 7 to 10 years. Because what they missed by assuming that the numbers were real or whatever is it took them a long time, I think, to figure out the actual market microstructure. But yeah, great book.
yeah, and I think also just to figure out strategies, like that example about how they were getting killed by the Canadians just because they didn't know how to trade, essentially, right? Or they didn't know that there were three people sitting on the other end of that Canadian future or whatever it was, right?
Yep.
Yeah, I thought that that made me chuckle. So yeah.
Yeah, I mean, when you have the power of Python going for you and you have some algorithms and you can run these algorithms. Of course, you can run them in the cloud, I guess, which is what you're doing, but you can even run them at home on a Raspberry Pi. You can have 5 or 6 running at a time.
Yeah, I don't know if I recommend that. I'm in the process of moving from the home server back into the cloud.
Uh-huh.
I was trying to alleviate some complexity, I think, by having it local or just having like a local. I think ultimately what I need to have is like a production playground and like a development playground. And right now
Yep.
that's murky. And so essentially I want to have both of those in the cloud in the future, right? There would be the production and the development in the cloud, but I'm not quite there yet. So
Mhm.
that's one of the things that I will be setting up besides working on strategies.
Well, I'm going to be speaking to some people in the algorithmic trading course in, I think, 2 or 3 weeks to kind of prime them for taking this course. And what I'm hoping is that there'll be a few good guys there who can join us during the next evolution of this course and even give you some help as far as, some data mining routines and so forth. So I feel like if we can get a few different market points of view, like what Ron has and so forth, and then a few different kinds of programmers, we can really move faster on getting something that can super scale. And that would be something where, besides just our own money in it, we could get public money. And it would have to be, as I mentioned last week, in the form of a hedge fund, because you can't do this with retirement money.
Sure. Would you think of this would be like an incubator hedge fund or like a full full hedge fund?
Well, I'm going to a conference in May where there are people who want to invest millions of dollars in something. So if there's enough interest, we don't really need the incubator, you know? Or we can start an incubator. I mean, the thing is that those things are not inexpensive. And I'm pretty conservative in the sense that I don't want to start a venture like that until I can really see that it's going to pay off. I don't feel like spending, $30,000 in a year of my life on an experience. So, the choice of structure is the last part. What I'm hearing you say perhaps is, how do we get something viable going quick? Is that kind of what you're asking?
No, I think it's just like, what are some of the steps that you see? And like, I've gone down some YouTube rabbit holes in terms of like creating a hedge fund, right? And I'm going to take whatever was said in these channels with like a grain of salt, but like, and plus there's these services like Repool. Have you heard of this?
Haven't heard of Repool.
Yeah, it's supposedly like a hedge fund administration type thing, right? Yeah. So,
well, you need to hire a hedge fund administrator to be the third party that figures out who owns what. There's a lot of really bad advice as far as forming LLCs and trading companies. There's a lot of really bad advice to give you the impression that you might be starting a hedge fund when really what you're starting is something that's A, illegal according to the SEC, and B, a humongous tax trap. So, yeah, best to be careful.
okay.
But you need some track record. You need, and this is probably, to my mind, what's most important, you need a pitch deck to show investors what it is they're getting, and you need to show it in a way that they'll understand. What you were talking about the time before last with that graphic you showed me with the bids and asks moving around, that kind of graphic would be really cool in a pitch deck. You need to get people excited about what it is you're doing. Of course, you can't lie. You can't get them so excited because you're not telling them the truth. But when you're dealing with accredited investors, you can get them excited about what you're doing. You can show them some preliminary results, and you can give them different deals, based on how quickly they decide to enter your fund. And the other thing is, a lockup period. You really want to get people who can afford to leave the money with you for a relatively long time so that you don't get, stopped out in the middle of a play because you have to suddenly come up with a bunch of liquidity.
Right.
You need a risk manager to figure out if during the course of every day, you are actually within the parameters you set out at the beginning. When you have any discretion at all, there's a lot of temptation to overtrade, over margin, over leverage, and so forth. And you really do need a third party to say, Joel, we have to flatten all these positions. And you're like, oh, come on, they're about to win. They're going to win big. No, we need to flatten the positions and start over. If it's really a big deal, you can just start scaling in now and it should work. That kind of thing.
Okay, thanks for indulging that part. But yeah, I think one of the other things is like, with the other Luma Wealth class, I've been able to take the classes over. But like to perhaps take this over again, and see what else, kind of develops in the next area.
Yes, I invite you all to take it over again.
Okay.
This was the first time. And what was good about it, I think, was that I was really able to just say, what do you want to do? Let's teach a course about it. As the class gets bigger, I probably won't be able to do that with a whole bunch of people. We'll have to do some things where we kind of make where we kind of teach to the most common denominator for some things. There'll be more beginners in it, but I'm not going to dumb it down. They're just going to have to study harder. Yeah. Ron, you with us?
Happy Sunday. Yes. How are you?
All right. All right. How was your week?
It's pretty good. Pretty good.
Good. Good.
Finished green. So yeah, no complaints.
That's the point, right?
That's right. How was your week?
It was a little confusing. I'm really not sure if we have kind of a temporary bottom in the market. The Fed seems to be moderating their speaking a little bit. And people are coming up with some good reasons for them to possibly moderate. So if that's the case and a bottom is in, I really need to change my tune a little bit.
Yeah, I don't think the bottom is here yet. This is a fake out to finish the month of October strong, and then one more dip before you actually get the bottom. And if you go back on your charts and compare it to 2008, it's almost identical.
Mm-hmm. Yeah, yeah. I just, I know that they said that in 2015 and in 2016 also, when we were having some pretty rough times. So I get what you're saying. So the question would be, do we need a Bear Stearns moment to end this? Do we need some incredible collapse?
I don't know. I don't get the Bear Stearns. What
Well,
happened?
what happened was that, what brought down the market in 2008 was the mortgage-backed securities.
Sure.
And the fact that banks were allowed to use things that were not very safe. Banks were allowed to use things that were not very safe, but they all got treated as if they were grade A, AA paper. And then when they started to fail in a correlated way. And since all the trading in these derivatives was over the counter instead of on the exchange, you couldn't tell how much risk people had in the market. You couldn't tell how many people had sold or bought puts on these things because they were all negotiated and they weren't published anywhere. And it turned out that there was about, when you think of all the money there was in the world, there was about 5 or 6 times that in the derivatives on this market. And people who thought they had literally billions of dollars soon had millions of dollars. And Bear Stearns collapsed and Lehman Brothers collapsed. And those two big bankruptcies, even though we didn't know it at the time, pretty much signaled the bottom because we really had washed out a whole bunch of bad money at that time. So some people like Ray Dalio think that there has to be an event at the bottom of the market, that there has to be something that makes everybody just dump all their stocks. So do you have a feeling about what, now I'm not saying that's true, but let's just say it is. Do you have a feeling about what that might be?
Everyone's banking on the housing market to crash, but I don't think the housing market is going to crash as it did compared to 2008.
Mm-hmm.
It would do a slight little pullback, but not as drastic as everyone's banking on. The only thing I'm possibly seeing, if we actually go to war with China, that will go ahead and give us a nice drop that we need. Other than that, yeah, that's pretty much what it is, because they fluctuate oil all the time. If oil goes up, everything goes up, supply and demand. But that's just been going for the past, almost 3 years. So you can only pull that trick so many times. So we need something major to happen.
Well, here's something major that might happen. Us stock guys, we never pay attention to the bond market because bond traders are 10 times smarter than stock traders. You can't fake it trading bonds. You have to know a lot of math to make money in bonds. And they're afraid that, and this has happened, when the Fed offers bonds for sale, they expect people to buy them. The more exuberant people are about buying them, the lower the interest rate is. When the Fed decides they're going to have an auction, if they're going to have to auction, I don't have the order of magnitude right. If they're going to have to auction off $10 billion worth of bonds, they're going to auction them off no matter what the lowest bid is. They need $10 billion worth. So if people won't buy them at 4%, they'll keep auctioning until they're buying them at 4.25 or 5 or whatever it is, whatever the stopping point is. And lately there's been some problems in the market because there haven't been that many buyers for our treasuries. And they've had to break things down into smaller sizes. It could be that seizing up in that market could be the end, as it were.
So based what you're saying, because no one's buying the bond market or investing in the bond market, it could cause a financial crisis in that realm.
Very definitely. Yep.
And why would it cause it? We're just pretty much allocating money somewhere else. Because
Well,
a lot of people look for
because-
more of a return versus tying the money up for 10 plus years in a bond.
The debt, the sovereign debt of the United States is pretty big right now. It hasn't exceeded GDP since World War II. And now it has quite a bit. And taxes are what pays for that. And the US, not only has the US never defaulted, but the idea that the US will not default underlies every financial calculation for the value of every other asset in the world. So if the US did default or even seem to be in danger of default, imagine, I don't know, what physics or engineering would be like if the value of pi was suddenly 3.0 instead of 3.14. If gravity was suddenly, I don't know, 3/4 of what it should be. Everything that's built on those assumptions is going to be unstable and have to change. That's how much people believe in the US dollar. So if that bond auction is unexpectedly large, taxes must rise in order to support it. Last week or 2 weeks ago, whatever it was, when Britain decided that, yeah, we have a lot of debt, but we're not raising our debt rate and we're going to lower we're not raising our interest rate and we're going to lower taxes, the value of the pound plummeted. So that's what happens when the bond market fails. It's not that just stuff goes other places. The US's prosperity depends on the fact that everybody in the world thinks the dollar is the base currency. The trouble is when our Fed decides to do things with interest rates, other countries like, I don't know, Indonesia, places in South America, they really suffer because their interest rates are raised and they don't have the tax base that we do. So yeah, bonds are a big deal.
So wouldn't it be easy like the Fed did for the stock market to just pump 1.5 trillion to boost it up to make it appears that it's doing well rather than let it happen, unless they plan to really roll out the new currency of crypto and then just kill the US dollar? That could be another possibility.
Here's the thing about Bitcoin. It doesn't belong to any country. And when the value of it goes down, it's just tough luck for people with Bitcoin. When people try to mess with the sovereignty of the US dollar, our Navy comes over and blows the crap out of them. That's what happened with Gaddafi. Possibly what happened with, what's his name, in Iraq, when he was trying to come up with instead of a petrodollar, petro gold or petro yuan. When people start to mess with the sovereignty of the dollar, bad stuff happens to them. So I don't think that they are going to roll out a digital currency and get rid of the dollar. I think that the dollar gets defended. So why doesn't the Fed just pump out another $1.5 billion? Because it would be an obvious sign of weakness. The reason that the Fed's raising rates so fast is because they want their credibility to be maintained. If they don't raise rates and inflation continues, the dollar becomes worth less and less. And that essentially indicates that people don't have faith in the dollar. So in order to create that faith, we have to make sure that people believe in it. We have to pay higher interest rates in order for that to happen. And when we pay higher interest rates, by the way, the rest of the economy has a little bit of a problem.
Wouldn't you say this is a forced inflation? I mean, we're almost textbook to every decade. We literally force a recession. Wouldn't you say? To kind of balance out things and the wealth gap. If so many people got too rich really quick, it's a way to really balance their the economy as a whole, to make sure not everyone is at exact playing field, if that makes sense.
Say a little more about that.
So I've lived through 2008, and the prior year, the prior recession, I wasn't able to live through because I wasn't conceived yet. But based on those patterns, it seems like the U.S. always somehow manipulates the world to force a global recession with the higher powers in order to balance out the actual wealth gap. And like back in 2008, there was middle class. Now with 2019, we definitely eradicate the middle class. So either you're wealthy or you just bill again and buy now. So then I guess the next 10 years, there pretty much be no comparison at all. Is either you're super poor or you're super rich.
What do you think is super poor?
Barely able to make maybe say 25,000 a year.
Yeah, so the poverty rate has increased somewhat, but it's still very small. And I'm going to say 10%. When you consider that half of the world lives on less than, $10 a day, half of the world, it's very hard to call anything in the US poverty in that sense. Of course, we all live in a very expensive neighborhood. But the purpose of these machinations with interest rates is not to level the playing field. The purpose is to increase the credibility of the US dollar. What happens when interest rates are low is that people who have access to capital don't need to get as much return on an asset in order to pay for their loans, right? I mean, I had many people, I encouraged them to take money out of their house at 2%, put money into the stock market, and even in a 30% downdraft, they will have, 3 to 5 times that much money by the time they get done paying their 30-year 2% mortgage. So when money's cheap, you can buy things that don't need a lot of return. When money's expensive, speculative things like, SE, if you ever looked at that symbol, it was up at 300. I think it's down at 50 now. Speculative ventures, growth stocks that don't make any money, well, they're not very valuable when money costs 5%. People are willing to put money in when money costs 2%. So what the Fed's trying to do when they raise interest rates is make it so that money's credible, inflation's low, and savers, people who live on a fixed income and so forth, are not too damaged by the inflation. I mean, if you look at their mandates and so forth, that's what they're trying to do. They have no sense that they want to level the playing field for people.
I wouldn't say level the sense where it's equal for everyone. It's basically creating a wealth gap. Like for instance, everyone in this phone call is basically, we have, I would say, common sense to how financial literacy works compared to the rest of the individuals that are not on the phone call. So technically, we have an advantage. The fact that we're brainstorming on Sunday after 4 to how to compound our money and make it grow for us, that's a huge milestone for compared to a lot of people.
So it's not a gap. It's our endeavor. We've decided to do that. Some people are drinking beer and watching football.
It's true.
The people who drink beer and watch football and don't come out richer a year from now have no right, in my opinion, to blame us for being richer. I don't think we deserve to be taxed more because we spend our weekends coding and figuring out stuff and and on compared to people who don't. Nothing in America is really stopping anyone from doing that. Do you agree or disagree?
Oh, absolutely. It's a choice. Now you
So
can
much
either
of it
get
is.
caught with the distractions, or you could. It's a balance too.
Yeah.
I would say it's a little bit of both, because not everyone has this equal opportunity. But if you have the opportunity, don't make use of it, then that's pretty much shame on them, because you have all the tools at your disposal and you just basically piss it away
Well,
where it happens.
the other thing is this question of opportunity and this wealth gap. I mean, my mom worked 3 jobs when I was young. She wore the same winter coat for 25 years. She was the daughter of an Italian immigrant. And their whole thing was every generation is supposed to do better, not every 4 years I'm supposed to be much richer or there's something wrong with this system. Okay, they anticipated that the struggle and the values would be passed down multi-generationally. So, you know, if you're not advantaged this generation, your efforts are to advantage the generation that comes after you. And you've talked to me about your nieces and nephews or and so forth. And I mean, you're doing so much for those kids. Not every kid has an uncle or a dad or whatever who will do that. But I do have to say that a lot of people in our position who are sitting around doing this kind of thing, at some point in their lives, will become a mentor, will do something to educate others and so forth. And I think that's where the wealth comes from.
Absolutely.
So the idea that there is a wealth gap and there shouldn't be one, I think is kind of silly. I think that if you can, I think it's silly because, again, people are trying to count things year by year, decade by decade. And what you really need to look at is, you know, humans have been around for 200,000 years, civilization for between 6 and 20,000 years. The question is, where was everybody 500 years ago, 200 years ago, and 100 years ago? That, I think, is how you measure the progress in the wealth gap. And in that sense, humans everywhere are so much wealthier. 100 years ago, I think it was 75% of the people in America were farmers, you know, making their own food. That's how they survived. They were subsistence farmers and sold the excess in Chicago. So yeah, we've come a long way. Okay, well, I am so pro-America that it disgusts some people. So I'm going to stop doing that and kind of orient ourselves to where we're at today. We have gone through finding a system. We all have one. We talked a little bit about scaling. Last week, we talked about how to scale with other people's money, some stuff about fiduciaries. Joel and I started to have a little discussion about hedge funds and so forth. And in the ensuing weeks or a couple months before the next class starts, I'm sure that we will be doing something to put together that structure. And here we're going to kind of do a capstone for this week and talk a little bit about some of the rules. And I want to evaluate some of these trading rules that are on the internet, in books, etc. So the first 3 I want to talk about are define your risk, have a stop, and always have an objective. So is that something, and I'm just going to go through the whole class and just put in your thoughts. And if you don't have thoughts on the matter, let me know. So when you're thinking about defining your risk, having a stop and having an objective, does it make sense to you? Do you always do it? Ron, is that something you always do?
Absolutely. Before going to a trade, you must have, at least my rules, have a entry plan and an exit plan. If not, you're just gambling. Same thing in
What
the
does,
casino.
yeah, what does a typical entry plan look like for you?
So based on my technical analysis, so if I'm using the 5 minutes to enter, and then go ahead and confirm that trade on the 1 minute, then I enter the trade, and then I have 1 or 2 parameters, either collect at 10% or wait for the EMAs to cross, or 2 red candles to exit. Actually 3 confirmations, or wait for 2 red candles to get out of a position. So one of
What's-
those 3 criteria hits, then I get out. If none of those criteria hits, or if it hits the 10% and I went pretty heavy, then I'm able to leave runners behind to capture the move.
Got it. Joel, how about you?
I guess that depends on if I'm manually trading or trading with a bot. I would say manually trading, no. I mean, that's part of the reason why I like bots, just because I kind of usually jump in without defining my risk, or find myself in a position where I'm like, hey, this position is way kind of outside compared to my other positions and my intention, right? Because like,
Yep.
I think that I just, and so always have a stop. I think, when I enter a trade, I usually have a stop in my mind, but at the same time, like, that's fallible and subject to moving. So, and then now looking at bots, I think the risk is defined. I think right now it's sort of fixed position sizing, but I'm looking into more dynamic position sizing. And then the stop, yeah, looking at how to incorporate stops. So I think one of the things that I'm thinking about in terms of stops is I might get rid of some of my upper stops, right? Just to keep my stop for losses, right? To keep that in there. Because I think initially I was focused on stops for wins, right? But now I think that's limiting me in a way. And I want to focus more on stops for losses so I can, let my winners run a bit more.
Got it. Good. Dan, are you audible?
Yes.
Oh, okay. Tell me about your risk, stops, and objectives.
I would say that I'm a lot like Joel in that when I'm manually trading, I understand the importance of these things, but I struggle to consistently implement them on every trade. I think I try to always have a stop. Sometimes I change the stops, and that's probably not a smart idea. I chose those stops for a reason. I could probably stick to it.
Yeah, one of the hardest things in trading is that the perspective and the reason can often shift. We'll talk a little bit more about this concept of a stop and so forth. For retirement funds, there's not a stop. The risk is controlled by controlling the liquidity. So again, if you've invested in, let's just say 100% spiders, there is no risk of ruin unless you start taking money out of the portfolio. And a lot of academics have pointed to 4% as being the number that will never bring you down to zero. That perpetually you could take out 4% a year and leave, not just leave money to your heirs, but leave the equivalent buying power, right? So now we're talking about inflation adjustment to your heirs. And that the mechanism for doing that, kind of fluctuates and so forth. At Porter Kickham, we've modified it a little bit by insisting that people have some very stable cash outside of the stock market. And I've begun to even modify it a little more with some cash value life insurance, leveraged cash value life insurance. So again, just a way to make it safer and safer. For retirement funds, no need to have a stop or an objective. The objective is something that you just monitor along the way and make sure that you're keeping up with your benchmark. So when you think about your stop loss or your risk, are you basing it on the chart in front of you, or are you basing it on your account? Joel, how about you?
Well, probably account.
So you're looking, your risk is equity based. Okay. Ron, how about you?
I'm based on what's in front of me on the charts.
So your risk is market based.
Correct.
Okay. Is it ever equity based?
I mean, I would say absolutely. I'm not using my entire account at one trade. So I'm using a portion, and then whatever I'm pulling to risk on that particular trade, I'm not going to risk the entire thing. I'm going to more likely risk anywhere between 15 to 20%.
Mm-hmm. Okay. Got it.
Does that make sense?
Oh, absolutely does. Absolutely does. Now, one of the things that we talked about, I think it was in week 4, was having a chart that showed what your wins and losses were compared to your equity. Because if you are always betting, if you have $100,000 account and you say, well, my risk on any trade is $2,000, then if you lose several times in a row, your $2,000 stop loss becomes much more significant than it used to be. Similarly, if you have some fantastic thing that has an 80% win rate, and you keep using 5 contracts, no matter what, your return on your equity is going to go down and down and down because you're not increasing your risk with your increased equity. So one of the things that you do when you trade as a business is actually reset those parameters. You know, it doesn't have to be every trade, but not hard to do it every week. Not hard to have a look at that and see what kind of risk can I take this week? Because then what happens is when you're on a run, you'll do better. And when you're having a streak of bad luck, it won't hurt you as much. So that's one of the things that kind of screws with amateurs. A lot of us talk about the VIX index. Joel, when I say, oh, the VIX is up, what do you think?
Like stocks are more volatile.
Which means?
There's more of this, right? I'm trying to think of the more technical term, but there's a
Greater range.
Yeah, like a bigger range. There's more ATR. I'm trying to think. There's a term, but yeah, not thinking of it though. But yeah.
Yes, the dispersion of the variance of returns increases. So, yes, we're not thinking in those terms yet. Ron, what's the VIX index mean to you?
The premiums and the cost is going to go up tremendously, so greater returns.
Greater value to those options. Got it. Dan, is the VIX something you look at?
Not particularly, no.
Yeah, I look at it. I mean, in the retirement accounts, I look at it to have an indication of how to talk to people. Obviously, in speculative accounts, I use it to figure out what the range will be in X days. So if the VIX and there's a specific formula for this, but the VIX can tell you that, for instance, the 5 days from now, the odds are that the S&P will be plus or minus 3.7% of where it is right now to a 68% probability. Or put another way, if we go through the next 5 days over and over again, 60%, 68% of the results will land in this area. And only, let's see, I guess that leaves 32%. Only 16% of the results will end up above that area, and only 16% of the results will end up below that area. So in some of the trading I do, where I divide the future up into 3 parts, high, neutral, and low, it lets me know where the boundaries for those parts are. So yeah, a lot of people don't really understand the VIX or how to use it. It's an important thing, and it should be in your toolbox. When you enter a trade, is there any way that you think in terms of the probabilities of its success, Joel?
I think I'm always going to win.
There you go. Okay. Ron?
There's a 50% chance it might go against me. So this is where I also use my timer. I typically spend 3 minutes within a trade. So if I'm staying longer within a trade, I have a problem. So do I either cut it if I have time, or depend on the stock I'm trading, or do I try to quickly justify my means of staying into that trade?
So you're betting 20% of your account on a 50-50 chance?
Yes, because
And your objective is a 10% win?
10%, that's to be on the safe side. That's correct.
Do the trades
There's times that, go ahead.
do the trades go against you 50% of the time?
No. It come out more favorable based on just being patient and waiting for the setups. So I look for high probability setups that will go in my favor for I just jump into the market. Before then, yeah, I would say 50% of the time, because I was a straight gambler.
Okay. Joel, you know, as we worked with your bot, we just started with a preliminary and arbitrary thought that every time it fired off, we'd like to make 1% of whatever it was that was invested or risked or whatever. Are you changing that percentage in some way, or have you worked on that at all?
Well, that was 1% per position, right? And I wasn't, and I was only, let's say, betting a portion of my account in that that position. Different paper trading than live trading. I'm really, to be honest, I'd like to study more of like what a trailing stop would do, because what I'm seeing is that when I get this 1%, I could have gotten way more. So I'm definitely like looking to adjust it up, or looking to see how I can do trailing stops as well.
Okay.
Yeah. Or let's say do that limit on only a portion, to say like, okay, once I've my 1%, maybe I'll only take half off the table at that point, or two thirds. So it seems fairly easy to catch this 1%, right? I think. So, but I think there could be more.
If you could make 1% a day, I'd be cleaning your house for you after 2 years.
For real.
I'd be cleaning your
Joel.
house. I'd be walking your dog.
Okay, all right,
Okay.
so.
So look, if 1%'s easy, freaking get it.
Well, okay. So then I think that probably, I think the other things that I'm really looking at more are kind of like turning down trading, because I feel like it's like the over trading is kind of like, well, what I'm essentially saying, right, is like, I may say, after 10 trades, you're done for the day, or like 2 or 3 losers in a row, you're done for the day. I think that the other thing is I'm really only testing like 2 or 3 days, maybe a week at a time. I really love to test this with over larger timeframes, but I feel like that would be, I want to have more sort of like data to study when I do that, right? Like to be able to return these MFEs and MAEs type things over these time periods. Perfection is
What brokerage are you trading? What brokerage are you trading? Are you trading live in?
Alpaca. Today it's Alpaca.
Okay. Dan, do you know if Alpaca plugs into TraderViz?
Oh, I also did. I got TraderViz and I pulled my trades into there. We can look at them if you'd like.
Yeah, I really want to look at that. Let's just run through the slides and that'll be the next thing we do.
Okay.
Yes, I really want to do that. Okay. Good. Ron, well, we'll get to it.
Yes.
As an option player, you use a lot of leverage. And what's important for you as an option player is to start to think in terms of not only the percentages of several different things. First of all, when you're in your trade for 3 minutes, how much does the underlying move in terms of percentages? And then also, when you tell me that you're in the trade for 3 minutes and you make 10%, are you making 10% on the account, or are you making 10% on the 20% of the account that you invest in?
On the 20%.
So you're making 2% on the account. Still incredible. And
Small wins adds up.
that's what Dakota told me at the Crystal Palace Dance Club. Them ones add up. So, so she agrees with you. And I agree. I agree also. The question is, and this will be for both you guys, is that if you look at the analysis, then it would make sense to add to your or risk more when you're on a streak. It really would, and that will increase your account literally logarithmically. Okay, so if Joel and Ron, you guys have bought into the extra project thing. So if you guys want to link into TraderViz and have conversations about it, even into November and December before we start the next class, just get on my calendar and have TraderViz available, and I'll be able to show you a few things perhaps that you haven't seen about your own trading. Okay, and that comes down to the whole keep good records, review them, and find a battle buddy. Here's the thing, trading is its own performance art, especially you, Ron. You're an artist, you're a scientist, you're out there in the arena. The people who are good at that are usually not good at keeping records. The people who are good at the performance are usually not good at the after action report and so forth. But there are a group of people who are very good at that. And combining those two talents will really boost your return. So I know Joel and I, we've been working with this. It's kind of a constant struggle because we each have our different priorities in terms of which direction this whole bot thing should go. But that's part of the fun, the struggle, etc. And Ron, if you hook your thing up to TraderViz, I think we can really get some more good results. But reviewing them to find out when a trade won and lost is really, the key here. So I just want to say that the trading in equity markets that Dan and I do is different from the trading in zero-sum markets, which is what Ron does. And what Joel is doing is not really trading in an equity market. What you're doing, Joel, is a kind of primitive data mining, right? You're saying if this event occurs, if the signal occurs, then I will get to a 1% gain sooner than I'll get to a X% loss 6 times out of 10. Or I'll get to a 3/4 8 times out of 10 before I get to a half loss, that kind of thing. So you're making rational bets. There's nothing wrong with making a bet if you're the house. In fact, if you're the house, you should make as many bets as you can if you're the house. So nothing wrong with it. It isn't gambling. We're not doing it for the thrill. We're doing it, or the dopamine. We're doing it for the bucks.
So to that point of the house in my strategy, like usually when I think of that metaphor, I'm thinking about selling options.
Yep.
Right. So is there, I guess maybe that's a V later.
No, you're correct in selling options. If you do it the correct way, you are the house. In your situation, you have a signal that gives you an intelligence. It gives you information that others don't have. Remember, the way to make the way that people make money in markets is because of asymmetrical information. You've got an edge. You know something's going to happen before everybody else does.
I'm counting cards. Let's say
You're counting cards, right?
Okay.
You're counting cards. And just like in the casino, if you get too good at it, everyone will notice. So some of those algorithmic things that we discussed the time before last will become useful as your size gets larger. But, a conversation for another day. But you can't be a card counter and walk out of there with all the chips for long. Yep. Okay. Nobody here, but lots of people in the webinars for this course complain bitterly that they don't know how to keep their winnings. Okay, and the reason is they don't know how to count their winnings. They don't know how to count their wealth. That Elements app, if you hook up your accounts to it, and every quarter, if you just go through the rest of this stuff and make the entries, will show you whether or not you're winning and alert me to things that I can let you know about how you can win better. What happens with amateurs is they open this trading account, they do well, they do poorly, this, that, and the other, it runs them ragged. And at the end of the day, there's no gain in their net worth. There's just a lot of effort. Okay, and that's because people don't know their numbers. If you don't know that it costs you $10,000 a month to live, you will get a vague feeling of anxiety when you only make $8,000 a month for 2 or 3 months in a row. But you won't really know because you don't know your numbers. So it's like that. It's like that. The last thing is white space. And I think that, Joel, we talked about this just today. And Dan, you've come back from a weekend of white space where I just feel sure you didn't think about the market. And it might be a warning to people like Ron and I that you really have to step back from this trading stuff, from this numbers thing. Because the parts of your brain that are used in these calculations and this stressful 3 minutes of holding $2 million worth of options and so forth. Those parts of your brain are different than the parts of your brain that relate to people, parts of your brain that create memories, etc. And studies have shown that day traders will lose short-term memory and actually show symptoms of dementia much sooner. If you day trade for 2 or 3 years in a row, it's possible that some of these changes are permanent. So it's very important to be doing stuff other than trading, other than numbers. Family, friends, sports, meditation, whatever it is, but something else, because you are not a machine. Who trades on the news?
Used to.
How'd that go?
I'd always end up buying whatever somebody was selling, right? Like, I mean, unless it's like you are kind of going against the grain, or you're just, there are times to trade the news, I think, but most of the time it doesn't work, because you're usually buying from the people who have the information ahead of you and are probably a better trader than you. So, I mean, I think trade events, with options a little bit better than you can trade the news. So like future events, but trading the news, it seems super tricky unless let's say you had a bot that could, let's say, essentially detect that kind of activity, news related, what I would call like news related activity, and then essentially like scalp that activity. Like that's the only, like in the future, I would plan on building a bot that, let's say, could essentially detect the only kind of activity that could be caused by news, and then just attempting a scalp, not essentially like a real trade, but just like, hey, if I could get it at this price and sell it at this price, okay.
Yeah, don't let it interfere with your 1% a day, though. But yes, absolutely. Now, Ron, you're trading indicators, not news, right?
Correct. Usually, the old saying is, you buy the rumor, you sell on the news.
Yeah, sell the fact. Yeah. Dan, how did you find Murphy? Was that a news article, or were you looking at charts? How did you do that?
Charts.
Okay.
As a momentum trader, I have found that the bar charts or bar chart. I always get that mixed up. Barcharts.com sells like charts for science teachers and stuff, and bar chart is the stock one. So bar chart has a high-low page that will show you all the stocks that have hit, of various time frames for your high lows. So
nice.
It has 1 month, 3 months, 6 month, 1 year, year to date, 2, 3, 5, 10, 20, and all time highs and lows. So you're looking at price and not news also. Yeah. So, Kathy Wood, has everybody heard of Kathy? Yeah. Tell me if you haven't. So Kathy's thing was not only to invest in growth stocks, and specifically stocks that were not companies that were not making any money, but had the next big thing. But Kathy decided that she was going to let the entire world know what all her holdings were all the time, which to me is like playing poker with your cards just out on the table all the time. So it went well when it was going well. And she got, all of a sudden, she went from managing millions to managing billions. Now it's not going so great. A friend of mine, Matt Tuttle, actually started a ETF, which is short all of Kathy's picks. She buys something, Matt sells it. She buys it, he sells it.
He started SARK.
Yeah.
Okay, I made some good money on SARK earlier this year before they figured out it was a leveraged fund and wouldn't let me trade it anymore.
What's his ticker?
SARK.
Short ARK.
Okay.
Yeah.
Yeah, and now there is a short Jim Cramer ETF.
Really?
Yeah,
Wow.
Saw that.
So basically FU money.
basically. So way long ago, when I first started, there was actually an article about what would happen is the Wall Street Journal would come, and if the first section of it was news, the second section of it was the entire financial world, and on the front page of it was some idea or other. Gold's at an all-time high, the drought is affecting wheat, whatever. And what they showed was that if a broker told his client, there's a drought coming, we should buy wheat, it says so in the Wall Street Journal. If that didn't turn out so well, the broker would be forgiven because the client would think, well, it was in the Wall Street Journal. So how wrong could it be? And somebody did a study back when it was really hard to do these kinds of studies, when you couldn't just download price data for everything in the world, when you had to really go back and actually put it into an Excel spreadsheet. Somebody figured out that if you would go in the opposite direction of the Wall Street Journal every time, you'd get a pretty respectable return. So again, this thing about the news, it's almost fortunate that the media has become so distrusted. People used to talk about not trusting the New York Times when I was in 6th grade, but now there's hardly a news source you can trust. So for us traders, fading the news is a good thing. We want to think like contrarians. It's hard to think like a contrarian. You are genetically predisposed to go with the herd. One of the ways that little kids get trained to do the right thing is by being ostracized when they do the wrong thing. It is physically painful to be outside the herd. It is physically painful to be ostracized. And that's one of the things that you need to do at times in order to be a successful trader, because as someone said, the market will move in the direction that will hurt the most people. Bull markets in equities will do anything they can to take the least amount of people with them. So that's why it's important to think like a contrarian and to understand who's influencing you. If you think that you can pick up Facebook or pick up the news and look through things and not be influenced by that, you're really kidding yourself. You really need to take a look at every bit of media, every bit of input that you get, and really feel what this is doing to your psyche one way or the other. I'm a big fan of meditation. It's part of my practice every day. To know what's impinging on your mind is just incredibly important, because then you're free to accept or reject it. If you are unconscious about what happens when you read a news article, then you'll be at effect of it. It will influence you, and it won't be your thoughts. Writing your hypothesis. Again, Ron and I might have a difference of opinion about whether this whole thing is over or not. But what's really important is for us to jot down just a few words about it. And this is why having a meeting with other people is important. Jot down a few words about it and see how those words ring true in an appropriate time frame. So thinking that the market's going to be on a tear up from here, and thinking that the end of civilization is going to happen all within the space of a day or two, should lead you to think about your thinking. Okay, your hypothesis, your opinion should change in harmony with whatever time frame you're talking about. There are a lot of people who are day traders who have grand opinions about what interest rates are going to do and this, that, and the other. And who flipping cares? You're not in the trade for more than 2 hours. Inflation isn't happening in those 2 hours. You're thinking about something else. Similarly, what really screws up people sometimes are somebody who's invested in a stock, the market takes a dip like it did 5 days ago, and it's like, well, I guess I should just be out of this. It was a bad idea. So somebody who has a long-term trade and takes a short-term signal and vice versa, these things will mess with you, but you'll be able to find out if you're making that mistake if you write down your hypothesis. So option trader guys, what's open interest and what's volume? Anybody have an idea?
Well, my layman's term is open interest is a group of individuals who take interest in a particular strike price. Volume is the lot of the number of traders like that particular strike price, and they're constantly trading that strike price in hopes to
So
get a
let me,
better
yeah, let
value.
me just straighten out one thing for you, and this is really going to help you. Volume is
Okay.
the amount of contracts traded. The open
Right.
interest is this. Every time a contract is traded, somebody is either buying to open or buying to close. Somebody else is selling to open or selling to close. Every time there's an open contract that remains open by the end of the day, open interest increases by 1. Every time lots of people are closing their contracts, then open interest is decreasing. So if price is increasing, if volume is increasing, and open interest is increasing, which way is price more likely to go the next day?
The same direction about where the market is.
Sure,
up or
because
down.
more and more people are taking these bets.
Correct.
More and more people are on the hook. Now, price is increasing, volume is steady, and open interest is decreasing. What's that going to tell you?
Look for the reverse.
There you go. Yep, absolutely. So especially in a futures contract, the difference between or the interplay between volume and open interest is crucial, and you ignore that at your own peril for sure.
Will we go over that this class or next class, the futures life?
Are you trading futures?
I wanted to once we're through with this class or doing a class. Remember we was going to trade together in the class?
Yeah, we can. Let's just pick an hour next week and let's talk about how we're going to do that.
Okay.
Okay, you have my schedule link.
Is
Okay.
it- you also mentioned there might be an opportunity with that in the bots as well.
Oh, absolutely. Listen, you guys should get on my calendar once a week. Okay, I get on my calendar. We'll talk about where you're at. I keep notes. We'll just keep going. And definitely join the class when it starts again in January. You'll be able to take advantage of the PDFs that I'm making up. You'll be sterling examples for the youngsters to follow. Everyone will want to be you. So that's what we're looking for. A couple of other things here. One thing that really made a difference for Caleb, if you guys remember him, he's a futures trader. There was 1 week where the market, the E-minis, gained about 150 points, and he made 5. And, you know, as you say, Ron, ending the week in the green, it's good, blah, blah, blah. But if that market goes up dramatically and you're not with it, you got to figure out that you're doing something wrong, because a move like that you're not catching means your system can certainly be improved.
Oh, absolutely. I
Yeah,
had that
and,
issue Friday.
yeah, and after that, I mean, he got short at some ungodly high number like 402. You know, and he was still holding it at 377. So at $5,000 per dollar, that was a pretty good move for him. Yeah, and very relaxing too. So amateurs don't pay attention to that. They don't adjust their wins and losses based on their equity. And here's the really big thing. Again, when I do these webinars about this course, people are like, well, I want to learn trading. I don't want to hear anything about investing. Well, okay, but you're never going to really get any wealth if you do that. Okay, there are levels of wealth. And as we've already established, unless you do the right thing, you're going to make the government richer than you are. Okay, because the government's going to take the money from your gains and you're going to be stuck with your losses. So you have to do a lot of right things about this. Furthermore, in order to have assets grow and not be taxed, they have to be managed in a different way. They have to be managed in other markets. And you need to supervise your own mix of those assets, because that's where diversification comes in. Being in the stock market in 10 different stocks is not diversified. Being in the stock market, having real estate, having a business, having life insurance, having some notes payable, some extra real estate, that's diversification. Okay, that's diversification that's going to work. Having 10 different stocks will seem like you're safe until you're not. And you'll just be done. And last but not least, after these long-term assets, is your total term. Okay, there's a number out there for you that's going to support your lifestyle, your family, et cetera, for the rest of your life. You got to know when you reach it. You got to know when you exceed it. For many people in their 60s, I know that's a long way off for everybody but me. A lot of people in their 60s have actually made so much money that they know they cannot spend it in their lifetime. And that's when they start to do things with charitable giving, with irrevocable trusts, as we talked about last time, et cetera. Knowing what your total term is, it's just a number on that Elements app, and you can watch it grow and grow. One other thing that amateurs are objecting to is pay yourself regularly. So there's a couple of ways of looking at this. Usually the guy says to me, well, guy, I'm making so much money. I don't want to take any money out. I mean, that's gonna make me take longer to get to where I'm at. And usually these guys really aren't at anywhere. Usually they actually have some kind of losing system. And if they take money out regularly, at least they will put something aside for when their account blows up. Now, if they're really geniuses and they're making 50, 60% a year or whatever the heck they're doing, then taking money out regularly will not really affect their top line growth. And taking money out regularly and putting it into the medium, the long-term, and the super long-term investments will actually increase their overall wealth, even though the apparent return on investment of those other assets is much lower than the 60%. So that's something that amateurs really screw up often. So right before we get to Joel's results here, what we need to consider is what's next, where are you going with your trading and so forth, what resources can I offer you to, I hate to say the next level, it doesn't even mean anything anymore. What resources can I put you in touch with so that you can reach your goals faster? My wealth management company is Lifestream Family Advisory. And I'm gonna, if I can find the chat, I'm gonna put this in the, well, if only I could type. Yep, not this time either. Okay. If you go there, you'll get an understanding of what it's like to have a customized family office for you. Now, obviously, I don't do all this stuff. I don't have the brain construction to do tax law. I enjoy legalities, but I'm not a lawyer, nor a bookkeeper. But I know people who are excellent at these and more things. And if you want to really create wealth that's going to last and take care of a lot of people, that's what we do. And those are some of the resources there are. So just, as you sit back and take a look at where you're going and so forth. And I know I've just asked this. It's a really big question. There's no reason you should have the complete answer in 2 minutes of hearing it. But, just jam a little on the answers. So, Ron, where are you headed and how can I help?
You mentioned you have a convention to go to in, was it May, to get to source funding for potential investors.
Mhm.
I'm sure that's not open to the public. So how does one seek conventions like those on his own or source those inventions? Or is it by invitation only?
Well, I got invited. I'd like to get you a little more prepared before you go. Because I feel like, if what you're telling me is, really works out in terms of objective verification, that with a pitch deck, you could do very well in a place like that.
With the right coaching, of course.
Pardon me?
With the right coaching, of course. If I go there willy-nilly without any experience, they'll just laugh at me, call it a day.
Well, they won't laugh at you because you have some really good results and you can speak. I'll tell you, there were a lot of laughable people there, but you wouldn't be one of them. But yeah, listen, you want to go there. Your first impression is your best one, and you definitely don't want to burn this group, because the thing is that they're basically the same people year after year. I mean, there's probably a 20% turnover or whatever, but you don't want to make a bad impression on one of the people who's always there. So yeah, getting a good pitch deck together would be good. And that Trader Viz thing could be the start of it.
Absolutely.
Mm-hmm.
I already put it in. I did it for one of my accounts. It gave me a good perspective. So now I'm going to do a new test run from scratch with Webull and put those metrics and turn the account value. So that way it tells you down to the hey, you stayed on average is 6 minutes, not really 3 minutes, because I've seen that part. Or you do better on a Tuesday compared to Wednesday and Thursday. I like that kind of matrix. And then instead of me taking manual screenshots or where I enter and exit, the application does it for me.
What application is
That's
that?
also a good thing too as well. The TradeViz that you introduced.
Oh, TradeViz. Yeah. Okay. Yeah, it does.
Yes. So there's, like I said, there's other little features within there. I'm still playing around with it.
Okay. Excellent. Excellent. Joel?
I mean, I'm going to try to get to this 1% a day that we talked about, whether it's through, kind of stopping at that point. But I mean, for the next couple months, I think, I sort of have this goal of making a certain amount of money, right? I think that you and I had talked about it. I think this has felt very exploratory, this whole thing to me. I think now I feel like I have more pieces to, like, more building blocks. So I just want to keep hammering away on the strategy. I'm also super interested in other sorts of strategies that are more broadly market-based. But I guess at what point do I start implementing that? And also would really like to paper trade more options type stuff, right? I have, because the times that I've built bots with options, nothing worked too well. But I feel like the opportunity over the next period of time, like once I get my, let's say, QQQ bot running and a bit more productionized, I would probably focus my attention on saying, okay, how can I start paper trading options through interactive brokers to essentially, that might be like another, I don't know, but that's a third thing that I'm talking about, right? So the first thing is perfecting this QQQ lever. Let's call it a leverage bot, because I think really the signal is kind of interchangeable. I think using leverage, marrying a signal with a leverage stock, that's what I'm doing, right? Second step is, I'm going to just say more, like I have an idea of a bot that can just look at, let's say the S&P 100, pick the top 10 that are throwing signals and essentially trade those for the day, right? Like something to that extent. And then priority 3 is to do all these same sorts of things, but with options. Probably it. And trying to focus on my infrastructure right now is at Alpaca. And that's really because of ease of use, I would say. And like ability to just like run my script and it works, and I don't have to worry about it too much. But I think medium to long term, I'd really like to move over to interactive brokers, because I even saw like last week or 2 weeks ago, I doubled my position size and the fills seemed to get way worse.
Oh, no kidding.
Yeah, no kidding. I mean, I don't know if it was like just the day or like coincidental, but I doubled my position size, and that was the worst day I've had running my bot. So I mean, there were a few other variables at play there, but it just seemed like they look way worse than the $5,000 position versus $10,000 position. Alpaca,
That's not a lot of money.
not a lot, but like you to your point, that could be a tenth of a whole bar, right? And maybe Alpaca doesn't have the muscle to really give me any price advantage there, especially that these are market orders. Mind you, this is market orders for ease right now. So
no, listen, really exploring the algorithmic orders that interactive brokers has already programmed for you will really help. So I'll go heavy in that next class, and either you'll really benefit from it or you'll be talking in depth about how you used it. It'll be one or the other. Between the two of you guys, and I've got a third guy who does some stuff in Forex. I mean, if we could really get together and have some type of quite diversified hedge fund thing and show people that as a pitch deck, that could be interesting. I have an idea of how much money everybody has, and it's not as much as you would have if somebody said, oh, please take 10 million of my dollars and do this. And somebody else said, please take 5 of mine, and on and on. So when you do that kind of stuff, you can count on getting a fee of about 2% on the money that you manage, not 2 and 20. That's kind of a little old fashioned, although there's still some people who will fall for it. But
you want 20%?
You get 2% as a management fee and 20% of the profit. Yeah, like I say, that's kind of old. People won't really go for that anymore, but you still can get some stuff where you participate in the profits. But honest to God, 2% on the money is pretty good. So Dan, everybody congratulate Dan. He's launching a career in finance yet again. He's moved up a step, working for the big boys now.
Wall Street. Congratulations.
No, I mean, I live in St. Louis, so Steeple Nichols, which is one of the 3 big players here in town.
Yeah.
It's a nice bump in pay, which is going to really help fund my trading accounts. So cover all those losses that I'm learning from, pay for that education.
Nice.
So yeah, it's good. I'm excited. I'm nervous. Going to be back in an office for the first time in a few years.
So what do you feel like in trading? What do you feel like is next, or where you want to get to?
I think the biggest thing that I need to work on is capturing profits. before my trades turn against me. You know, as a momentum trader, I'm swing trading. I'm not day trading. I'm not scalping. I'm in for weeks or months. But you know, then the market turned, and you know, a lot of my positions that I was up pretty well on are now underwater. So just trying to remember to take some profit.
Okay. No, that's good.
Maintain, you know, the rest of the system on a more consistent basis. Making
Okay.
Sure that I don't enter a trade unless I've figured out a stop loss and attach that to the order. You know, being more diligent about reviewing my trades instead of, you know, sticking to a system and trading on facts and logic instead of emotion.
And the whole thing about the system and so forth, again, it has to do with some record keeping. I fall down on that myself, but one of the most important things you can do is that. I have to say that somebody reminded me the other day that it's really important for me in doing this class to, well, here's the risk I take. We all make mistakes. If I admit mistakes and somebody gets a hold of this and they happen to be a client, I can get sued for the losses because here I am admitting a mistake. So it's a little harder on me.
Recording. It's just us. Turn off the recording.
It's just us, but everything in the world happens to get out somewhere. I mean, God. So it's a little harder for me to, you know, admit mistakes. I have to just phrase things a little more loosely, but you know, in our private conversations, you all get what's happening. So that's good. That's good.
Can we meet up in person? Is that better? That way I get to authenticate.
Yeah, there you go. Hey, do you play the piano?
I don't mind. I'll take
Yeah.
a trip.
All right, all right.
I play
Do you play
guitar.
craps? Ron, do you play craps?
No, I suck at craps, but I play blackjack.
There you go. Well, we've got casinos over here. And yeah, we'll have some fun. So for me, where I'm going is I'm going to review painfully all of the videos for this class and create PDFs that go more in depth with the written materials, which you'll also find in every day there. I hope to kind of put those together a little better. I'd really like to have a class with maybe 10 or 15 people in it. And you guys could help me if Robert would get in touch with you, if you would give a testimonial, if you like the class, if you would give a heartfelt testimonial, that would really help. And I'm going to be studying a little bit more programming. I really want to get into this whole hedge fund thing and, you know, make a pitch about an integrated hedge fund that can do some good for people. So that's what's up for me. And with that, Joel, would you like to show us Trader Biz?
I have a couple other maybe one or two other things I wanted to touch on. Yeah, just the going from like a personal trading, right, to the trader tax status was one of the things that you had mentioned,
Mm-hmm.
right? And then the sort of the hedge fund, right? Are the trader tax status and the hedge fund, those things aren't mutually exclusive, are they?
No.
Right. So somebody could have a trader tax status trading on their own and be involved in a hedge fund. You know, as a person, could I potentially have my strategies involved in both? Or
Well, the people in the hedge fund are not going to want you trading outside of the hedge fund.
Okay.
Because people have done that before, and they, you know, you take other people's money and sell something to yourself, and then, you know, there's all sorts of mischief that can happen.
Okay.
So the point is, if you have a winning system, get yourself trader tax status and have some results. We'll get together, we'll do the hedge fund presentation. If it turns out that, you know, there's enough interest, you switch over to being one of the hedge fund traders when it makes economic sense to you.
Okay. And then the other, just to kind of some of the things you said you were going to do, I was just kind of wanted to get more of your thoughts or your impressions on the book, the algorithmic short selling with Python. Like, just want to see how far you are in it and just like your super high level impression of that book.
He's one of the smartest guys I know in finance.
Uh-huh.
I am not very good at Python yet, so it's hard for me to comprehend as much as there is. So as far as the English goes, he's taught me a great deal about relative value. And my impression is that if one were to go through and really comprehend that with the experience of a trader, it would put you levels above other people. On the other hand, doing it with less than $1 million or $2 million in assets might be kind of hard because, you know, he's not trading when the red line crosses the blue line. He's managing an entire portfolio. So he's taking a look, and this kind of addresses one thing Dan talked about. He's taking a look at all his positions, and if there's some positions that are lagging, he's going to get rid of those. You know, the risk manager is going to take a look at that and say, let's have a talk, you know, and so forth. He does not believe, by the way, that if something's doing really well, you sell that off. That's a retail idea of rebalancing. He's willing to let something that's working keep working. Now, as a short seller, it's a problem for him. When you buy an equity long, your thing can go up 300%. When you sell short, what's the most you can make?
100%.
100%, yeah. So that's a disadvantage of the short seller. On the other hand, if you want to make your 300%, it might take a couple of years. As a short seller, you might make 50% in 2 months.
So I just going through the book, I've had a hard time reading it just because I feel like the prose of it, there's literally 5 metaphors in every paragraph that are something about like I don't know, and I found the book hard to read that way. Like I think some of the Python stuff seems decent, but like I've had a hard time just getting past the like his metaphors. Literally every paragraph, there's 3 to 4 metaphors, and I'm like, I don't understand what you're talking about.
So between you and I, we could understand the book.
Perhaps, and maybe we could do some, like, I wouldn't even mind if you and I, in some of our Friday chats, we even just go through a couple of those chapters, because I read it and I'm like, I really have no idea what you're talking about. And so then the Python is like this, because I don't understand maybe some of the
Okay.
yeah. And so I feel like there's some really good stuff in there. And I feel like ultimately what I want to build is what he talks about in the last chapter, the portfolio management system. Like that's ultimately what I'm trying to build. But like that chapter has 0 technical details in it, right? And I've read it several times, and some of it I've sort of absorbed, but some of it I'm just like, I have no idea what you're talking about, just because he uses so many metaphors. So yeah.
Good. That's a good thing for us to do. And I owe him a little white paper on something I've been working on. So if I get an appointment to talk to him, I will see if he'll let a couple friends tag along, and I'll let you know.
Interesting. Okay. The other thing, and going over to TradesViz, so some of the data looks incorrect to me. So like some of it looks correct and some of it looks incorrect, and I just haven't really had a time to dig into it. So
You haven't heard that, have you, Dan? Yeah, Dan's elsewhere.
No.
Yeah, no, it's all worked for us, right?
Yeah, perfectly. Yeah, no, I'm kidding. There's been a few pickups. Did you catch the part where you have to manually add in any deposits and withdrawals?
no, in that I don't know. There's just like all my trades should be day trades, and for some reason there's one trade that was like opened like a month ago or something, and then it shows it closed. Or that's what I think is going on. I did take a withdrawal per guy's advice, and that was in that period, and that could actually be the issue actually, because it does look like it for some reason, but no, but it looks like it's greater than that. I'm not 100% sure.
Yeah, and I don't think that would be an issue with it not proper linking, the two sides of the trade. I think that would just show some issues with some of your charts and stuff. So that might be something you have to reach out to their support.
None of your trades are over a year old, right, Joel?
Well, no, I've had this alpaca account for definitely over a year, and I've been, kind of messing around in it, for lack of a better word, for over a year. That has definitely slowed down over the last couple weeks that I've been taking this class. And the times that I'm going to show you should be purely algorithmic trading. And, Guy, you and I've looked at my spreadsheet, which kind of reflects some of these same time periods. Let me make sure I have the right screen here. Just put this one. So I connected this actually to 4 accounts, 2 paper accounts. Alpaca and IB paper and Alpaca and IB live. This is Alpaca paper. And I actually did have what I'm calling like a new version of the bot. This is like a 2.0. It doesn't really reflect the early stuff we talked about, but this ran by itself this week in my paper account, and this is what it did. I don't know if this is accurate because I'm just actually kind of seeing this for the first time.
Well, the 5,600% P&L is probably not accurate.
No, that sounds incorrect. These sort of daily P&Ls, like if I look at Alpaca, let me see if I can put that here. It seems like it's about right. So let's go look at paper really quick. So this is paper. So this looks incorrect because this would have been the bot just running by itself on Friday. So it looks like it lost money. Looks like it lost about 300. And here in TradesViz by themselves, they're showing a $1,200 win. So let's see if we explore trades. There would have been a lot of trades here. So, I mean, yeah, I'm not sure I believe this, but if we look here, I think over the last, this will be month. So this was paper trading with automated bot, I think was all this week here. And then let's just look at live here. Overview. So for like 10
Question.
this looks accurate, right? This looks inaccurate, this looks accurate, and this looks accurate. So I mean, I was making like 50 to 100 bucks a day for about 2 weeks, around the first 2 weeks of the month. And then the 17th, I ran kind of like a new version of the bot that I hadn't tested a lot, to be honest, and went with the double size position. And that's where we lost about 360 here. So yeah, I got as expected, had my rear handed to me without a well-tested bot. I increased my position and hadn't tested it, and of course didn't do as well.
Perfect.
Right. Works as expected, as they'd say in the software industry. Yeah. And so here I can, I'm not, I just show I'm just above the PDT here. And if I show you, I think this is, let's see, if we look at the dates, I think this is where I took, is this where it was? Yeah, this is where I paid myself right here, right? So I was doing like a little bit okay. I think this was prior to the automated, I don't know, I think I started automating about here. Yeah, So I started automating here, right? At the end of week 1, paid myself, kept automating, then V2 of the bot and lost it. And then this week pretty much didn't trade except for Monday when I had those losses. Haven't traded the rest of the week, except for in the paper account. Because I wasn't around this week to basically be able to babysit it.
Okay, are you able to get to the thing that talks about the maximum adverse excursions and so forth?
That in here,
Yeah,
where would I find that?
let's see, trades analysis charts. Yeah, go to win rate.
So I don't, let's see. No, I don't know which account I'm in. But this should be the live account, right? Yeah.
Okay, scroll down a little bit. Okay, that's not it. Look at the eggs. Oh.
Huh. Maybe I have to massage the data a little bit or re-import it. So I think this is going to be helpful. Ultimately, I'd like to have kind of my own charts and kind of be able to pull this information into my own system, but that's next year.
Yeah, not as important as making the thing win.
Exactly.
And this trades viz is probably all you need to get up to that point. Then you can expand from there.
I'd rather pay the $20 or $25 a month, whatever this is, and have it sort of work than to spend more time on visualization at this point. Absolutely
smart idea. Yep.
Yeah, and then when this is like becomes the crutch, or this is, you know, in the way, right? Right now, this is helping me. At some point, that 80% working will be in the way, and then I'll spend the time to improve it.
Absolutely.
So
good.
It's the progress that I'm making in my trading it's not a quick trip, but it's a long adventure, lifelong adventure.
Yeah, well, listen, it's always an adventure. If you know, as a little surprise for you guys, if you go into the Google Drive for day 10, we have an academic article that has 101 alpha generating strategies. The holding period is between half a day and 6.5 days. Of the 101, approximately 80 are actually in use by a real algorithmic trading company. They were released with permission. Nobody stole them. And the way that they've annotated some of them might be hard to understand, but it's worth going through to see if you can even understand a few of them. I know nobody here is really a big math head, but it's important to know that this is happening. People are working it. When you look at some of these algorithms that produce profits, they're pretty simple. I think one thing they say though in the thing is not to be afraid to hold it overnight, because increased turnover, that is getting in and out of something, for these signals at least, did not really increase the profitability. So there. Ron, if you're in a 3-minute move someday and you're finished for trading or whatever, I'd encourage you to hold on for a little while longer, and then just in your mind, randomly take the trade you would have taken. If you would have bought 7 at the money calls, just at a random minute, imagine buying 7 at the money calls and seeing what happens in the chart. Because there's a way to mathematically figure out how much of of what you're doing is noise and how much of it is real information. But you can intuitively get that if you'll just a couple times a day when you're not trading, say, well, what if I just traded now? And see what would occur from that.
Thanks. I'll apply that.
Yeah, just check it out. Any questions from anyone else?
Yes. Do you use TradeViz to link with your clients' accounts to manage their portfolios as well?
Well, we have just added it on in the last month because the thing that we chose at first did not really work out very well.
Okay.
So we switched to TradesViz. And since our accounts are older and have gazillions of trades in them, we're having some trouble. And what we decided was that if we look at this for 30 days at a time only, it should get more and more accurate as the way older trades just kind of drop out. So instead of trying to get it, and the other thing is we can't show this to clients because it's not official GAAP compliant accounting, et cetera. There's a lot of reasons why it's insufficient to actually show a client. So as long as we know how to look at it, we're okay.
Noted.
Mm-hmm. Yeah. Hey, did you get that insurance license?
No, not yet.
Not yet.
Almost.
Okay. Yeah, so we're just kind of fooling around and seeing if it works. And, kind of just like Joel said, it does some things we like, and at some point we'll move on from it.
I found a couple Python repositories where they attempt to model these 101 alpha things. This is fairly interesting.
Don't get too interested.
No.
I know how your brain works, man. Don't get too interested. I was really debating about even sharing this.
I'll forget about it.
Yeah, just forget about it now. Look, here's something shiny. Yeah, so good.
Squirrel.
Oh, no. Back to my signals, regular signals.
Yeah. Anything else for anyone? Cool. Well, listen, I have really enjoyed giving this class. You guys are, I could not have asked for better students. You're also involved. You're really doing it. 98% of people who take online courses either never finish them or never do anything with it. And as Ron said today, here we are spending a Sunday afternoon trying to figure out how to do stuff, and we're all really involved in it. And it's rare. It's just rare. So I know we're all going to do well. We're all going to keep in touch. Of course, you're welcome to keep coming to these classes as we have them. I think I'm going to do 3 a year. What I really want to do, though, is get the talent together for a good hedge fund offering and present that and get it going. So and it seems like everybody in here is certainly has potential to be on that team. Okay. So I hope I talk to everybody soon. Just make an appointment on my Calendly link, and we'll go from there. And listen, if Robert gets in touch with you and you feel like you'd like to, a testimonial would really help. Okay.
Sounds good.
Will do. Appreciate it.
Okay. Thanks, everybody. And we'll talk soon.
Thanks,
Yeah,
guys.
it was a pleasure, everyone. Thanks.
Nice
No
meeting you.
problem. Have a great week.
Bye-bye.